Good evening, everybody. Welcome to the, I was about to say the market close, but it's not the market close. Welcome to the channel member exclusive video for September. Tonight, we're going to be talking a little bit about selling stocks. So we'll talk, my goal is we'll talk a bit about rebalancing. And then from rebalancing, we'll move into other reasons that you might sell outside of rebalancing. So we got a whole bunch of stuff that we're going to cover here tonight. And in addition to that, there is, of course, any questions that you guys have, want to pop up, anything you guys feel like talking about. We're here for all of that. We're here for all of that. I think it's going to be a pretty banger of a show. Now, a little bit of housekeeping. Just before I went live, I did drop an email there on the community tab, or I guess a post. And next Friday is the members' choice video. So that there is, everybody gets to watch the video, but you guys get to choose what it is. So get your ideas in. And once I got a good, I like to have 5. Honestly, I like to have at least 5 ideas. We'll get a poll up, and then we'll vote. Yeah, I'd love to have that poll up and running, well, before Sunday. So I wouldn't mind having it within the next couple of days. So if you got some ideas, and it can be anything, I'll just point that out. Maybe there's a deep dive you want me to do. Maybe there's a list video. Maybe you're like, I want some high dividend ETFs. I want that. Maybe there's a tutorial that you have in mind, and you're like, okay, this is what I want. Can you do a video on swing trading, on the basics of it, or something like that? There's a lot of different ideas that you guys can come up with, and I can't wait. I can't wait to see what they are. The exception here is because this is for everybody. If you ask me to make a video on making the perfect banana bread, not gonna do it. Not gonna do it. It's kind of outside of the realm of the channel. So that's the only little stipulation that I have in regards to that. All right. Whew. This is the funny thing too. One of the things that I don't know if I want to say it annoys me. It does a little. I have no idea how many people are here. Right now, I can see 3 comments in the chat. So I know there's at least 3 of you here. So I don't know. And it's because it's a non-public video, they don't give me a head count at all. So it's like, yeah, I got no clue. All right. But nonetheless, always good to see you guys. Let's just say a quick hi to those who are here, and then we'll get started. All right. We have Chad in the building a bit early. Ha ha ha. Yeah. I saw that. 6:17. That is a little bit early. I hope he didn't fall asleep by the time I got on. And we got Jonathan saying, not late. Nope, not late at all. And then we got JJ. Whoop, whoop. Early crew. Bow down to your mod. Oh, boy. Yes. JJ is a mod. And the power's gone to his head, but it's fun to watch. So I'm okay with it. I'm just going to say, that way. We'll leave it at that. All right. So let's start. Let's talk a little bit about rebalancing. So in the challenge, so the 0 to 100K challenge, what I do is I do a quarterly rebalance. So that means every quarter I will rebalance. And that is, that is kind of the way I handle it there. There's many ways that you can approach it. And we're going to talk about a couple of different ways that you can approach rebalancing. So let's first of all define rebalancing. So basically rebalancing, it's basically you're fine-tuning your portfolio. So you're looking at your portfolio, you're deciding which stocks perhaps don't work for your portfolio. And it could be for many different reasons. Maybe they're underperforming. Maybe you are over-diversified, or maybe you just want to take some profits. The other thing is maybe there's nothing wrong with the stock, but you want to free up some money for another opportunity that is out there. So there's a whole bunch of different ways, a whole bunch of different things that you can talk about when you are looking at rebalancing. So, definitely not Definitely not a, I don't think it's rocket science. So if I had to actually put a definition on it, I would just say adjusting your portfolio to maintain your desired asset allocation. That's basically what it boils down to. It may involve, of course, realigning the weights of assets in your portfolio because that does happen. Um, Most stocks, if they're just single companies, I kind of like to keep them at about 5%. So when I do get a stock that maybe it did really well, maybe it did really, really well, I might have to sell some of that off to get myself back down into that 5% area, depending on the stock. Now, I will admit there are times um, that I do let a stock sit heavy for a bit, and that's okay too. It doesn't mean that I have to. For me, because I do a quarterly, if I get a stock that's over heavy because let's say it did well, I'm probably not going to address that until that next quarter. So that's kind of the way I do it myself. So let's talk a little bit about why is it important to rebalance, first of all. Why not just leave everything as it is? Just, let it go. Because you probably heard that saying, that stocks are like a bar of soap. The more you handle them, the less you have. And that is true. That is absolutely true for many, many reasons. Because when you are fiddling around with your stocks a lot, you do get kind of caught up into that buying and selling at the wrong time, getting the emotional part of investing in there. So, if you sell a stock because it goes down and you're worried about the stock, and then it turns around and then you're like, oh no, now I'm missing out. And then you buy it back. That's like a horrible idea. So there's a lot of different things like that. And we're gonna look at all of that as we move along. So one of the biggest things, I think one of the biggest reasons for rebalancing is overall your risk management, because that's what rebalancing typically is about. There are definitely different variations of it, and we're going to talk about those. Don't worry about that. But with that risk management, this is basically preventing your balance from getting way too out of balance in terms of diversification. So you could get into a situation where you find yourself completely overexposed in a sector that you don't want to be overexposed in. That's a perfect time when you do a rebalance. That's a perfect time to get those numbers back in line. So for example, if you look at most ETFs, managed ETFs, a lot of them will do quarterly rebalancing as well. Some of them do semi-annual. So what that would mean is, especially, let's say, for example, you're an equal weight. So let's say you're an equal weight bank ETF. So you do equal weighting of the Canadian banks. So what you're going to have is when your rebalancing comes up, you're going to look at that weighting and you're going to see, some banks did really well in that quarter. Some banks perhaps are moving in the opposite direction. So that would be like a BMO. So here's that thing. And this is actually kind of brilliant. I kind of like this idea here. I'm going to let me just pull up the Jamboard. So if you're looking at a situation like this, and here we go. Let's say you have a bank that's performing well. So National Bank. And let's say you have a bank that's not performing really well. So BMO. We're just going to look at these two banks. We're going to keep it nice and simple. All right. So if National Bank is all of a sudden doing well, and let me get myself a marker. All right, here we go. So National Bank is doing well. We got, it's moving up. It's moving up. So as a result, if in this case here you have you got 6 banks. I want to show you guys something. This is a math tool now. So within Notes, because of the newest update to the newest I/O for Apple, I can do something crazy like this. So if I have 100% and I want to divide it by 6, all I have to do is just put that in and hit my hit my equal sign. Let's try that one more time, and it will actually do it for me right in notes. I think that's just really, really cool. So basically 16.66 is what we're looking at. So if we were doing equal weight of the big 6, ideally we're looking at, let's just say 16.7. Ideally, we're looking at somewhere around 16.7% percentage. So because this bank has gone up, National Bank, we could get into a situation where, let's, whoops, come on, I want the text again. We could end up being, let's say we end up at, 19%. So we might end up at 19%. Now, at the same time, let's get our other arrow going. Whoops. We're just making, I'm scribbling the arrow a bit just so that way there, if you're on a smaller device, it makes it a little bit easier to see. So with BMO coming down, what you're ending up with is, once again, maybe you end up at 15%. Or that's actually, no, let's 14%. So, you may have had the same number of shares when you started, but now BMO, because it's gone down, has 14%. Here's where this is really brilliant. And this is something people probably aren't thinking of. So what you're going to do here, let me just bring this back over here. So you will sell some in your rebalance. You will sell some to get your number. Let's just say sell back to 16.67. We'll just put that in here. Holy banana bread. Let's put it up like that. There we go. So you'll just sell yourself back to roughly where you are. You're not going to be maybe it won't work out to exactly 16.67. That's just the way math works, but you'll get yourself close. And then down here, we're going to do the same thing. Can I copy and paste that? Ooh, I can. So in this case, we're not going to sell back. Edit. In this case, we're going to buy back. All right. So this is where this is brilliant, right? What you're actually doing up here is you're basically taking profits. So that's what you're basically doing up here, is you're taking profits. And I always say taking profits is not a bad thing. Now down here, and this is what's really brilliant, is you're kind of, here's what you're doing. Let me get to my thing. You're basically banking future profits. Whoops. Let's bring that over, drag that down. You're banking future profits because where this is down, it's going to rebound and you're going to get those profits. So you're actually, the stuff that you buy in here is probably going to make more money in the long term than the stuff that you sold up here. So that's why I'm saying you're banking future profits. So this works. And this is one of the reasons that rebalancing can actually be really good. Because some people are saying, and you'll get these people who say, I will not sell something if it's in the red. Okay. Well, in that case, and we're going to talk about that a little bit later. I guess this is not technically that situation, because in this case, you're buying while it's in the red. But we are going to talk a little bit when we get to reasons to sell. That's going to become one of those things that we're going to definitely talk about, because there are reasons for buying in the red, for selling in the red. There's very good reasons for selling in the red. So we're going to get to that here momentarily. But for right now, this here is just the whole general idea of why this is very effective, because you are creating future profits down here and you're taking profits up here. So that's fantastic. And then these are back. And if next time around, if these positions are reversed, you're doing the same thing, but you're maximizing. You're maximizing your overall profits within this scenario. And that's kind of what that's what a management team will do on an ETF. And that's what you can do in your portfolio. Because technically an ETF is just like your portfolio, other than the fact that they probably have, in some cases, they have a lot more stocks in their basket than you have in your basket. I would love, no, actually I wouldn't. I would not love to see this. But imagine something like XEQT where they have like thousands of stocks. Yeah, you couldn't manage that on your own. You really couldn't. But yeah, so that's kind of a neat little thing. We'll come back to the board as we come along. So I do like that example I just gave you. I sort of think of that as being performance optimization, because basically you're locking in the gains from the overperforming assets and you're buying those undervalued assets as you're topping them back up. So it's really not a bad strategy at all. And it's one of those reasons that I think rebalancing is very, very important. But we're going to talk a little bit about some of the actual rebalancing strategies here in a minute. But we do have a few more people popping into the house. So let's quickly say hello before we push on. We've got Enid in the house. Good afternoon, evening, everyone. Anybody took profits today? I did not. Vineet is in the house with a hello. And Vineet and JJ are just bantering back and forth. All right. Kind of cool. So there's a few different, there's basically three main approaches, I think, to doing this. Let's go back to this. I like it. All right, we're just going to clear the board. We will, quite literally, there was a little button here for clearing the board. And there it is. It was that little ad thingy. Knocked it out. So there are three main types of ways that you can approach balancing. The first one, and we're going to talk a little bit about each, is basically a time approach. So we'll call it time-based approach. All right, that's annoying. It should just do its thing. But you know what? If I just do it this way, then I don't have to do it on the next one. All right. The other approach, I'll name them first, and then we'll talk about them. Is basically a threshold-based approach. Look at this. This is like Mickey Mousing it. I've got all caps here and proper here. Yeah, I have to fix it. It's kind of that thing. I'll look at it and it'll just bug me. There we go. So we got time-based approach. We got a threshold-based approach. And third, but not last, and probably the most effective, I think, is basically, I will just call it hybrid. So it's a combination of the other two. All of that fun stuff. All right. Now, I did see Funny Books has come in the house. So hello, Funny Books. Welcome to the stream. JJ, did you really give Vineet a timeout? Holy banana bread. Vineet does not deserve a timeout. Just saying. Oh, boy. All right. So let's talk a tiny bit about the balance approach. So as you know, the time-based. So the time-based is kind of what I'm using in that 0 to 100K. At least that's the core to my strategy. And the time-based is basically saying, okay, in my case, I'm doing it each quarter. So once a quarter, I am doing a rebalance. So That's the thing. With a time base, you're basically looking at regular intervals. It's almost like at the dollar cost averaging approach to rebalancing. So you may look at you may do it quarterly. Some people may just say, you know what, I'm good with doing it once a year, and that's fine. It has to be something that works with you. Now, some of the huge advantages of a time based approach is one, yeah, it's pretty predictable. And it's simple. It's got that simplicity and that predictability. It's really easy to manage. It's like, okay, you know, maybe the first day of every quarter, I'm just going to do it. So it's not bad. It's not bad that way at all. However, there's one downside to this, is that sometimes you don't need a rebalance. And if you're using a time-based approach, you might come in and your portfolio may be perfectly fine, but you may fiddle with it unnecessarily. So you have to keep that in mind. If you are using a time-based approach, there's going to be quarters you're going to come in, you're going to look, and you're going to be happy with what's there. And it's okay to do nothing. It's completely okay to do nothing. So that's kind of a good thing. There's actually a fourth one as well, in a way. I'll talk about the fourth one, but it's not a main strategy. It's kind of a minor strategy. All right, now the threshold-based rebalancing. So once again, this all goes back to diversification. So this is where you look at it and you're basically rebalancing when an asset deviates by a certain percentage. So let's say, for example, well, this is where I wish I had a second page. Well, maybe I do. What is this? Oh, that's a sticky note. All right. All right, we've seen these. We'll clear the frame. We'll go to a second page. So you may have a situation where you can sort of say, all right. So, and I'll give you currently what I use. So for stocks, so basically when I say stocks, I'm talking very basic, simple stocks. I have a 5% on that. So that's what I like to have. I like to have about 5%. All right, so that's stocks. Now, let's talk either ETFs or multiple asset stocks. There we go. That's a good word for it. All right, now for that one, I have to put the edit again. That one I like to have 10%. That's kind of my rule on that one. And I'll explain. I'm going to just pull these over a little bit here. I'll explain what that means here in just a moment. And let's just do this. It's actually easier than clicking the thing again. The worst thing is I'm starting to really like this gem, and it's going away October 1st. So it's like, why are you using it? You're only going to be disappointed on October 1st. All right. And then I have sectors. And so my number for sectors is 20%. So these are the numbers ideally I like to have. So regular company stocks, so Enbridge, Fortis, TELUS, Scotiabank, things like that. It's just a simple single company. And then, of course, ETFs or multiple asset stocks. So a multiple asset stock would be something like Canoe, because Canoe invests in other companies because they're an income trust. Brookfield Asset Management, that would also. So Brookfield Asset Management, I can have 10%. Canoe, I can have 10%. ETFs, now one exception. If I have an ETF that only invests in one company. So let's say, for example, one of those single company ETFs, like those new ones out by Harvest, that would fall under the 5% because it basically boils down to how many companies they have. And then I have sectors at 20%. So these are where I want to be. But when do I get into a situation where I need to rebalance? So with this, I usually, and let's add my deviation in here. So I have 5%, and usually I won't put the minus part, but normally I'll put maybe plus 2% as kind of my upper limit. So if this stock gets up to 7%, I'm probably going to do something. I will probably sell some of it and get myself back down. But between 5 and 7, I'm not going to be worried. That doesn't mean I'm not going to rebalance them when I have a rebalance on that quarterly, because this is where we're talking about that hybrid. So I will, outside of regular rebalancing, if I have a stock and it gets up to 7%, I'm probably gonna sell, take some profits, and push it back down a little bit. That's what I will do. So I will step outside of my normal quarterly if it gets to that point. And with this one up here, once again, it's kind of similar, but it's a little bit different, and it'll make sense here in a second. So with this one here, my danger zone is 4%. Why is it twice as much as this one? Well, because I'm dealing with twice as much. Relativity, if you look at this relativity wise, they're about the same. They're about the same. And when it comes to sectors, I think you guys can guess what this is going to be. I don't even think I need to tell you. It's going to be 8%. So once again, relativity. So my rule is the same for all of them in this case. But because this is 20%, it's double what this is. Because this is 10% to 5%, it's double. So those are my rules outside of that. So if I get above it, I'm going to start doing something, because as much as I like some of these stocks, I also, to me, it's very important to keep my diversification in check. So I kind of go with that approach. So it is a hybrid. So the hybrid basically, it combines the threshold and the time base together. So you rebalance at set intervals, but only if allocations have shifted beyond a certain threshold. So you could look at it that way too. And it really boils down. Like, I'm probably a little more hardcore. So, what you can do is you could sort of say, let's say these were your thresholds. You could, just say, okay, well, I don't care what happens in between. I'm just going to do this at rebalance. But I will look at them in between. And if something does get out of whack, especially going up, I don't worry about it going down. But if something really is going up pretty high, I'm going to skim them profits anyway. I'm going to want to, because it makes more sense to skim those profits and put that money into something that's lower. So once again, I'm basically managing that profile to try to maximize the amount of potential profits on the long term. So it kind of works out that way. So definitely, definitely kind of interesting. Now, there, of course, are some factors that will influence rebalancing timing. So, and this is kind of one of these things. So even if you have a fixed time, when you're doing threshold, for example, or you're doing a hybrid, one things that may come in, like, for example, if we have a lot of market volatility, that usually in a very volatile market, you might want to rebalance a bit, maybe a little bit sooner than quarterly, for example. So that will definitely have an effect on it. Another thing, and here's another thing. So let's put this, let's clear this. Well, clear. I'm kind of liking using the board. I'll just do it this way. Boom, boom. All right. Loving it, loving it, loving it. All right. So market volatility. Yeah, market volatility can certainly, can I just do it this way? Oh, I can. Perfect. I don't have to make separate ones. Market volatility is definitely something that can impact the speed that you're going to do it. So in a much more volatile market, you might have things that are going up really high and they're going to come back down. So you may be looking to take some of that profits on the high, right? So that is another thing where you may want to do it. Now, some people, depends. Now, if you're a long-term investor, you may not care. if you're less than a long term, so if you're more of a mid-term investor, a short, or also a short-term investor, you're probably going to be impacted by this more than anything else. Another big thing that can affect you big time, life events. It happens to all of us. Sometimes your financial goals are changed due to circumstances outside of your control. And that could very well lead to, well, it could lead to a rebalance. It also could lead to a point where you need to, you might need to take some profits perhaps if you didn't, let's say you didn't have an emergency fund. Oh boy, that's a possibility as well. So just something to keep in mind. Now, some of the other things that can change too are your risk tolerance. So let's just say this, when you start as an investor, sometimes your risk tolerance, you don't even know what it is. So if you're a brand new investor and you're new to this, the risk tolerance that you have today, when you're setting up, for example, a rebalancing session or how you're going to approach rebalancing, your risk tolerance might be completely different as you get more experience under your belt, as you understand the market more, or even if you understand some of the dangers as well. Because sometimes I've seen people come in and they're like, woohoo, I'm going to do some pretty crazy stuff here because I think I got the market down. And sometimes you make some moves that you look back after a few years on the market and you're like, I would never do that today. So that definitely happens. Or sometimes it's the exact opposite. You get that new investor who's afraid. They're like, I've always heard that people lose a lot of money on the market. And maybe they come in ultra conservative, and then as they get experience, they begin to understand how things work. They start to loosen up a little bit. So there's a whole bunch of different things that you can definitely look at from that perspective. Another thing that can absolutely have a big impact on this is taxes. Tax time. So as we start to move towards tax time, that's when we start to look at, tax loss harvesting. So you may strategically be doing some of these things to help reduce your amount of taxes. So that could be something that would spur you to do another rebalance. So that's another really good thing to do. Now, keep in mind, if you're holding everything, like if right now, if everything you have is in a registered account, then ignore the taxes part. Ignore it completely because you don't have to worry about it. I have had people say, I have actually had some of the questions that I've had some people actually come and say, so how do I do this tax loss harvesting in my TFSA? And I'm like, you don't have to. There's no taxes there. So, and I don't, it may seem like a silly question, but it's really not. There's only one, and this is gonna be sort of a cliche, but the only silly question is the question that's not asked, right? Because, I'm okay with that. Like, I know, when I very first started investing, I threw everything in my personal account. I was just building it up in there, and then I figured out the TFSA, and I'm like, oh. So I had to sell everything and then move it over to the TFSA, and take a little bit of a hit too, as in, just a little bit of capital gain hits. But that's fine. That's fine. I mean, it's a learning process. And this is one of the things I love is that when you have channels like this one, and so there's a whole bunch, there's a lot of channels out there that are helpful as well. It's great when new investors find me or find somebody that, they can sort of get those questions answered, no matter, how newbie they are. It doesn't matter. Just fire them away. We will answer them. I will even, and if you guys have seen in at least one of my threads, on one of the videos, I get this big, long French conversation going. I'll answer in French. I don't need to understand French. Or honestly, probably any language. If I can tell what the language is, I'll answer in it. But I mean, obviously, if it's some obscure language and I have no clue, um, then that might be a little more difficult. But I will do my best. I will certainly do my best to do that. And oh, this is something really, really cool, by the way. So I was looking at some of the updates that are going to be coming out for YouTube over the next, probably over the next year and a bit. But one of them is they want to use AI to do dubbing on videos. So, for example, if English is not your French language, of course it's not. If English is not your first language, with some of these new features, you'll basically be able to go down and click on the language that you want, and AI will then dub your favorite YouTuber into that language for you. So that would be fantastic. And this is why I'm really excited, because I've wanted to have my videos in French, because excuse me, French is the other official language in Canada. So I'm thinking that would be a good way to go. With this, anyway, with that, I was thinking I was going to have to maintain two channels, a French channel and an English channel. But with some of the new stuff that's going to be coming out over the next year and a bit, I'm not going to need to do that, because, if French is your first language, you'll just be able to go down there and click on a little thing, and the AI will then dub me real time into French. Now, on the videos at least, I'm not sure how it works on the live stream. That would be very cool if it works on the live stream too. But for now, at least it looks like it'll be the videos first. So I think that is going to be absolutely big. All right. Now, before we start talking about selling, just a couple of best practices. So when you are looking at rebalancing, one of the big things to do is have rules, have a policy. So establish a rebalancing policy in your plan, in your overall investment plan. Get it in there. That way you're in good shape. You won't be deviating from it, and you won't be sort of going off and trying to make things up as you go along. The other thing is a certain level of discipline. So when you have a plan and things are looking bad on the market, you definitely don't want to give into that emotions. So you don't want to give into fear, uncertainty, or doubt, called FUD, or even FOMO. You want to just sort of sit back and you just take it calm, take it easy. Your plan is in place to protect you, and that's why you want to follow it. So, that was weird. Just as I was talking, all of my screens went into night mode. So it's like all this white stuff just went black. So I'm like, that's fun. Well, yeah, you can sort of like, you can see this one here was white a little moment ago. Now it's black. So all fun. All right. Before we get on to the selling, let me get caught up in chat here. All right, Vanita's here. And yes, of course, I've always got your back, Vanita. Always got your back. Let's see, doing okay, working at the moment. And JJ sold all of his canoe. Well, canoe was up big time. It's not a bad thing. It's not a bad thing. So, I mean, if canoe keeps on going like it's going lately, when we do get to the next rebalance, I might have to sell a tiny bit. I might have to. Actually, I probably don't. I think I'm pretty low enough in now. I want to know. All right, let's find out. Give me a second here. Here we go. Boobadoo. All right. Over here. Canoe. Oops, here we go. Right over here. Yeah, we got lots of room. It's only sitting at 7.21%. And as I mentioned, 10% is where I like to have it. So it's in fine shape. Still sitting at a total return of 21.47% though. So that's pretty cool. All right. Jordan is in the house. Good evening. I was going to say afternoon. Good evening, Candace. Hope you're doing well. So the big news here is actually two stories. Yes, Tupperware is filing. I saw that for Chapter 11 bankruptcy. Yeah, Tupperware. But they've been struggling. I mean, they've been struggling for a while now, so that's not, it didn't surprise me. Um, Other than the fact that, I think everybody's grown up with Tupperware, so it's like, huh? No, no, not Tupperware. And Bonnie and Jordan have bought a car on Tuesday, back on the road. That's fantastic. Awesome. Congratulations on the car. I hope you guys are going to get some good use out of that. That's for sure. It's nice to have wheels. It's nice to have wheels. Show us your Ottawa-tation French skills. They're bad. They're bad. They're bad. I can swear in French, but I'm not going to do that on stream. Now, I can say basic stuff like, let's see. Le stylo sur la table. I think that means the pen is on the table, something like that. Yeah. Anyway, JJ says, I'll help manage your French channel. Well, I don't need it now, right? I don't need it. It's going to be all in one, which is good too, because the French channel would basically be non-monetized, and it would have to go through the whole same process to get to 1,000 subs. And so, yeah, I like this. Everybody can just be all in one happy place. So I'm liking that. I'm really, really, really liking that. Let's see. So it's a Chevy Trax LT. So a small SUV we can use for our vendors events. Ooh, that's good. Let's see. Montrez te compétence. Yeah, okay. Yeah, all right. All right, JJ. Stop showing off your French. I don't want to have to break out the translator. Eventually, though, the way things are going, it will be, I bet you, now, I'm talking a couple of years out, but I bet you within 5 years, you will be able to come into a chat room like this and type in any language you want to. And then for me, because I'm English, everything you type will come out in English for me. And then every reply I put into the chat, or just talking live, will come out in whatever language it is that you speak. So I don't think we're that far away. I really, really don't. So I think it's going to be kind of cool. All right, Paul is heading to work now. We'll have a good shift. Have a good shift, Paul. Yeah. Are you working overnight or just into the evening? Now I keep remembering. Now, if you're on the West Coast, I guess it is earlier. Let's see, who buys Tupperware nowadays? I think everybody just has Tupperware. That's been around forever. So I don't know. I have not bought Tupperware in a very long time. Yeah, and goodbye, Paul. Jordan says that we do. We have lots, and they sell it too. We might have to find another side hustle, Jordan. You might have to find another side hustle. So, not the best, not the best. All right. Now we're at the selling. We're going to talk about selling assets. Oh boy. So here's the thing. When you're selling, there's a few different things. Obviously, we talked a little bit about rebalancing and some of the selling that can happen in there. We're not going to talk about that selling. That's fine. That's just a regular type of rebalancing selling. So we're talking outside of rebalancing. So what might happen that makes you want to, that makes you guys want to sell an asset? So there's a few different things that might make you want to do it. And we already talked on one. So we did talk tax. So we're just going to put some of these in. Tax loss harvesting. So tax loss harvesting, definitely one of the reasons that you may want to sell, outside of a rebalance, or maybe you're even going to incorporate that into your rebalance. So tax loss harvesting. So that's fantastic. That is definitely a good strategy. All right. So that is one reason. Another reason is maybe you want to sell because the company's not doing so well. So we're going to talk about company performance. So if the company is doing poorly, maybe you you're like, I'm sick of this. I'm sick of the stock going down. I might want to sell. So that could be another reason. All right, here's a good one. So let's look at industries. Industry trends. Here we go. So what's going on with that sector? So I'll give you a great example. Right now, we've been talking, we've been a little bit crazy about REITs because right now REITs are going up. But eventually, when we do get into that next situation, and this could be years down the road, eventually when we get to a point where all of a sudden interest rates start going up again, we know that's going to deflate the REITs. So there's a possibility that, if you see that starting to come, you're thinking, okay, it's time to get out of REITs. I got out of REITs last time before this happened, before all the rate hikes happened. So that might be another thing right there. Let's also talk about economic indicators. So if we're looking at the overall economy and things are looking really, really bad, and there's indicators firing like crazy, and everybody and their dog thinks we're going into a recession, that's not that far off from where we are, but that could make you want to sell some stuff, move some stuff over into cash. So, and now in a case like that, it really, well, we're going to talk about each of these anyway. I'm just kind of getting a sort of an overview of just a few different things. All right, so let's start with we'll start with tax loss harvesting. So with a tax loss harvesting, it's kind of this thing. If you have stocks that, we can move this around. Nice. So if you have stocks that are in a personal account, so they're not in a registered account, as you know, when you sell at a big gain, you create capital gains. And sometimes, the capital gain, you're going to pay taxes on it. Now, depending on how much, if you make a lot of capital gains, you're going to pay more taxes because we do have that new rule that the government has. Or, if it's a capital gain on a house that isn't a primary house, you're paying more capital gain tax on that as well. So there's definitely some stuff that you're going to be doing. Oh, I got my coffee here. So here's that thing. What you can do is when you have a situation where, you're going to be creating a lot more income through some winners that you took over the year. Let's say you took some profits earlier in the year and you're sitting back and you're like, oh man, the taxes are going to kill me on this. Well, you have an option. You can look at something that you have that's currently in a deep loss. So you can sell a loss and apply it against, I'm just going to do the straight drawing on this one. So you can have a loss and you can apply it to a gain. And that will effectively lower your taxes. So that's fantastic. That is fantastic. But there is a caveat to that. So when you buy or sell something at a loss, and you're going to move that money somewhere. So chances are you're probably going to, for me, how I would do it is, let's say, for example, all the banks were down. I would sell a bank at a loss and move it into a similar bank in a similar situation. So that way all of that upside is going to come back. So I'm still going to get the full recovery that I would have had if I hadn't, but I've created that fake loss. But when the banks recover, I have created, if I were to sell that bank that I moved my loss into, I will have a bigger capital gain. So it's not that I haven't made taxes disappear. Well, I haven't made them disappear, even though it looks that way. What I've done is I've parked those taxes on that other asset that I bought. And when when recovery happens, and if I were to sell or take profits, I am paying more because of that. Now, that one exception is if you've got space in your TFSA. And sometimes, keep in mind, a lot of people do their tax loss harvesting in December. Then in January, they get new space in their TFSA. So if you were doing some tax loss harvesting in December, you could always just sit on that cash, or even just move it into like you could move it into like a cash ETF if you wanted to, or just sit on it. I mean, it's not for long. I would probably just sit on it myself. And then the stock I bought, so let's just say it was BMO. So if I did some tax loss harvesting this year on BMO, well, here's the beautiful thing. I have that in my personal account. I can sell it in there, create that loss, and then I can rebuy the whole thing in my TFSA. And that loss becomes free, because as BMO recovers, all of that recovery is tax-free. So that's a one little loophole that does exist there. And it's very powerful. It's very powerful. Actually, one of you guys mentioned it to me one day, and I thought about it, and I'm like, my God, that's actually brilliant. I'm trying to think. I think it was Ian. I think it was Ian who mentioned it. If I'm wrong, and whoever did mention it, I apologize, but I think it was Ian. But I thought it was a brilliant thing. And in fact, probably in December, or even November, I probably will do a video on it, because I think I think a lot of people don't know that that's a really good way that you can go. But that's your tax loss harvesting. And I will reiterate that you can't do that inside of a TFSA or an RRSP. You don't have to do it. So this is for once you've got those maxed out and you're living in your personal account, that's where this is going to come in. All right. We're going to skip company performance for a minute. We'll skip that for now. So industry trends, and we already kind of hit on industry trends. So that is very much like, is that an eraser? Oh, I think it is. Oh, I got an eraser. I can't make it any bigger though, because I want to erase. Oh, I have an idea. I don't know if this will work. I do not know if this will work, but we're going to try it. All right. No. All right. Command C. All right. There we go. Clear frame. Command V. It worked. I love it. All right. It's so sad that this is going away. All right. So industry trends. All right. We'll look at industry trends. So once again, certain sectors will do better. So for example, when AI first came on the scene, one giant industry trend was tech. So tech was going to be going up like crazy. So obviously in that case, you're not going to sell tech. You're going to hold on. You're going to add to it. So that's kind of a good indication of an industry trend. Or when we went into the bear market. So it was kind of interesting. When we went into the bear market, tech went first. Tech led the way. So tech dropped basically about 1 month ahead of everybody else. So tech dropped about a month. So if you recognized what was happening with tech and the fact that they were dropping as fast as they were, that, I made a bunch of moves. I did sell stuff at that point because I suspected we were going into a bear market by watching this harbinger. And interestingly enough, when we left the bear market, it was led by tech as well. So sometimes tech can be a leading indicator going in. Not always, though. Keep in mind, you have to kind of pay attention to what's happening around. At that time, tech had the big issue of, I think the metaverse really kind of screwed them over a bit, Because the metaverse, in theory, not that bad. Meta V, there we go. All right. So yeah, the metaverse was in theory not a bad idea, but the execution was wrong. People weren't ready for it. People really weren't ready for it. And I don't think people wanted to sort of have a world that looks like Minecraft. So here's a funny thing. If they waited, if the whole concept of the metaverse didn't come around until after we got deeper down the AI rabbit hole, I think it could have been a completely different gambit. I think it could have worked. And we might eventually revisit the metaverse. But I think AI was kind of that thing. Like the metaverse didn't really have a chance, and I felt bad for Facebook when they changed their name to Meta. It's like, you probably shouldn't have done that, but they have done well. They have actually utilized AI in a very good way. So I do like that. I do like that as well. So industry trends, that's the whole thing. Pay attention to the market. Know what's going on. If you know that there's something wrong, like, so for example, if you are looking at oil and you hear that, it looks like oil's starting to build up a surplus and you can see it already starting to come down, that might be an indication that if you want to sell oil because you're still in a profit, that may not be a bad idea. In some ways, what you might want to do is if you know that oil's in for a slump, you could always sell as you're going into that slump. So, you could always sell up here and buy down here once things start to look like they're going to come back up again. So that's kind of an interesting thing. Just something that you can certainly do. And that's all about that industry trend. Now, economic indicators, once again, there's so many economic indicators, and I'm not talking about inverse curves or inverse yields. For me, it's like, go back to the basics. So, for example, what's happening with the tax cuts? That's a good indicator. That's a very basic indicator, but that it is going to impact companies. You know that real estate's going to do well while rates are cutting. That utilities will also do well especially if they have high debt. Anybody with high debt, you can sort of look, and you have to sort of logically look at how lower rates is going to impact different companies. So, and that's kind of thing. Now, if you have a company with high debt, but they also have a really big moat, it's probably not going to impact them as much as a company with high debt that has a smaller moat, because they're probably more strapped, and that's going to be a big relief for them because they have that less of a moat. So just something to keep in mind. All right, company performance. This is kind of a big one. So when we're talking company performance, and here we go. Let's clear the frame. And you know what? Company performance should have their own. Give me a second here. Let's get back to letters. All right. Go away, you little thingy. All right. I'll just drop you down here. All right. All right. So company performance. One of the big things that I tend to like to look at with that is fundamentals. So as you guys know, I do a lot of I would call myself a fundamental investor for the most part. So under company performance, I am going to look at, and where's the other one at? Down here. We'll bring it over here. And let's bring that over. All right. Oops. There we go. Come back here. It flattened itself back out. Oh, dear. All right. So something that we can look at is something called fundamental deterioration. I probably misspelled it, but that's okay. As long as you can to read it. Let's see, DETERIO. Oh, I think there's an R in there. I think there's an R there. Deterioration. That's closer. So fundamental deterioration. what does that mean? So that basically means that something's going on with their fundamentals. So when you're looking at fundamentals from quarter to quarter and you start to see things going down. So for example, return on equity is going down. All of a sudden they've got a negative earnings per share. Things like that. These are the things that are going to make you want to take a harder look right away. And a lot of times, because when you first look at a company, right, you're going to do your fundamentals. So that's your due diligence. You're going to go in and you're going to say, okay, these are the reasons I'm buying that company. So as fundamentals start to decay, they start to fall apart, they start to get worse. That's when you have to actually ask yourself, is this a company that if I looked at it as it is today for the first time, would I still be interested in investing in them? And sometimes no. Sometimes that can be exactly what's going on. So yeah, that is a reason. That is a reason to sell. Now, if they're in the green, that's perfect. But sometimes they could be in the red in a situation like that. So if you are losing confidence, you're losing conviction in that company, that's where I would tend to look at maybe making a sideways movement. So, if let's say, for example, we'll just use the banks. I like the banks. So if everything was going horribly wrong with BMO, and the banks are probably a bad one to use, but we'll just say for whatever reason, they're actually no longer profitable and everything is looking really, really bad. Well, I might look at another bank and, that might be down, but their numbers are not decaying. And I might go sideways. So if I'm in a personal, of course, that works out to tax loss harvesting. If I'm in my TFSA, it doesn't really matter. So I am going to take a loss on one. I'm going to move it over to another because it comes down to if you have loss. Like some companies, even big companies, they do go out of business. Probably not going to happen to the Canadian Big Six, though, which is why it was probably a dumb thing to use as an example. But nonetheless, it can happen. So it is something to sort of think about. All right. Another reason that you may want to sell red or green is, let's get back here. Edit. All right. Opportunity cost. So what do I mean by that? Sometimes you may be looking at your portfolio and you're thinking, okay, I like what I have, but I don't have a lot of REITs. And I'm going to use REITs now as an example. And you're like, I really want to move some money into REITs because they're doing well, and I think they're going to continue to do well. So you may, in that case, you may sell for that reason. You may, sort of take a little here, take a little there, pull some stuff out. Maybe there's a company that it really isn't performing. It's not doing bad, but it just isn't really performing. So you might even, sell out of that position perhaps and move it over to some place where they will have basically a better chance where you're looking at making more profit, more money from them. So, and that makes sense. To me, that's logical. To me, that's very, very logical because a lot of people will do that. A lot of the institutions are constantly deploying their income elsewhere. They're looking for opportunities. And if you remember that example we gave earlier with the rebalance with fund managers, they're doing that as well. Because, here's the thing. You can sit on a stock that maybe it's growing slowly and you're going to make 2%. But everything's fine. It's blue chip. It's great. But here you've got a REIT that's probably going to make you, 15%. Well, 2 versus 15, it's kind of a little bit of a no-brainer. And there are REITs out there that are like, you don't have to go into something like RMAX. You could go into something like RioCan or a good old AP.UN. I know a few people love that one as well. There are different REITs that you could certainly look at, but that's opportunity costs. So that is, of course, one of the other reasons. Now, Of course, we already talked about this, rebalancing, of course. So rebalancing comes back in here. Oh boy. Left out an A, rebalancing. So once again, we've already talked enough about rebalancing, so we'll leave that alone for now. But that is another reason that you probably might want to go into some selling opportunities here. And let's see here. And of course, and we already talked about tax loss harvesting. That's of course another reason as well. But and the rebalancing, technically, even then, it's not under company performance, but it can be. It can be, because when you're rebalancing and you have to decide, like if you have like utility companies. So let's say, we'll do this. We'll do this. I want to. So let's say you got Enbridge. So you got Enbridge, you've got Fortis, and you got Algonquin in there as well. And so let's say between all of these, you're sitting at, let's say you're sitting at 30%, because you've got a lot of these utility type companies. Well, Algonquin, company performance, yeah, Algonquin doesn't have that. They have had deteriorating stats. So if you're going to rebalance this, let's say you're gonna knock that 30 down. Where are you gonna get that from? You're probably gonna take it from AQN. It makes sense. These are much more stable. They're also already showing signs of benefiting from the rate cuts. Algonquin is a sinking ship. So in that case there, it becomes a no-brainer. Algonquin is, we'll put a little line through them, because yeah, they're the ones that are gone. It's like bye-bye Algonquin. So that gives you just a general idea of things to do. So, those are some of the reasons, of course, that you're going to sell. Now, things that you don't want to sell. There's a thing called panic selling. That's something you don't want to do. If you're in a panic, you should not be selling anything. You really shouldn't. Basically, most panic selling happens because of a short-term price drop. And people get in, they get that fear. They get that uncertainty. They get that doubt. They're thinking, oh my God, this is going to crash forever. And it's not. It's not. If their fundamentals are sound, you're fine. You just got to wait it out. Some people will call it diamond hands. You can call it that if you want, but it just makes sense to wait it out, let it rebound. You're going to be fine. It's just, it's a way to prevent yourself from getting yourself into real trouble. Another big thing is, I know I always mention due diligence, but you know what? The more analysis you do on stocks that you are putting your money into, the better. It's never a bad thing, because, you look at it this way. This is your money. And I like to say in the videos, your hard-earned money. And it is. Money doesn't come easy. So why are you going to throw it away easy? Don't. Do your due diligence. Go in, take a look at the stocks. Take a look at the fundamentals. So when you're watching my videos, what you should be getting out of it is, what type of things in the fundamentals should I be looking at? And you can take it even a step further. So for example, if you really want to get in there, a book I recommend is actually the Dummies line. I love the Dummies line of books. So there is a fundamental analysis for dummies out there. It's a great book. That was the very first fundamental analysis book I read. That was the one. It gives a really good foundation for understanding. So the more you know, the better you're going to be. I mean, sure, I'll always be here. I'll always keep on adding information and teaching and helping you guys the best I can. But, that's one way to take it to the next level. So absolutely. And that's a whole thing too. And if you're at that point, let's say, me giving you as much information as I do, you just can't get past the emotions. At that point, if you can't do it on your own, then you might want to look at consulting professionals. So that is something that's out there. There are some good financial advisors. I would always say avoid ones that have a bias. So, for example, if they work for one of the big six banks, they're really going to push a lot of the bank's ETFs on you, or even mutual funds. Things that have higher fees, they will tend to push that on you. So if you are going to get a financial advisor, I would almost say get an independent one that doesn't work for a specific bank. And try them out. Don't just sort of go in all in. Try them out. See how they are. Ask them questions. See how they respond. All of that can it can help you get the right person. And that's the thing. If you feel like, if you do go down that route and you got yourself a financial advisor and they don't feel like the right person, bail on them. There's no problem with that, because you don't want somebody who is not going to be effective with your money. You definitely don't. So just something to keep in mind. Another thing is there are a lot of you have access to so much stuff. Everything from financials online. Every company will have their financials. They publish it online. There's all kinds of different analyst websites that go over these things as well. And plus, there's a lot of YouTube videos as well that can help as well. So those are just things. Just keep yourself in the loop. Keep yourself in the loop. When you are thinking of your long-term portfolio, though, have goals. If you have goals for your investment strategy, it's going to make it harder for you to make mistakes. And always remember, volatility is inevitable. The market runs on it. So be prepared for it. Know that eventually you're going to hit a bear market and you may have to look at a red portfolio for a couple of months. That's, over time, though, I'll just put this out there. If you're a long-term investor, you will get to a point where even a bear market won't push your portfolio into the red. It might bring it down, but it won't push it into the red if you've been investing for a long time. So, now those of you who are new and have been doing it not for that long, yes, bear markets are going to push you into the red at this point, but it gets better. It gets better. All right. Now, I want to touch, I guess the last thing I want to touch on here is when it comes to selling and short-term traders, that's another beast all on its own, because if you're short-term trading, you're probably doing either day trading or you're doing swing trading. And actually, we don't need the board for this. You're doing one of the two, or you're either doing short-term trading, swing trading or day trading. In those cases, once again, you still should have a strategy when it comes to selling, but you're selling for completely different reasons. You're not investing in something because you're holding it long-term for the fundamentals. A lot of times you're investing in something because it has a good volume and a good volatility, so that you can make some plays on it to make some money in the shorter term. So in a case like that, I usually will still say, we have a visitor. Here, come here. Oh, she just came in from the outside. Oh, here she is. Say hi, kitty. She was out for a walk. And she's got the little glow collar. This is Winter, by the way. There you go. You guys get to see Winter. All right, Winter. I'm going to put you back down, kiddo. So she just happened to come in to say hi, which is fun. So, and they all of the cats, when they're out, even if they're just in the backyard, they've all got glow in the dark collars. So
yeah, we went out for a walk for a while.
There we go. Jill says they went for a walk for a while. So not too shabby. But yeah, so once again, short-term trading, the rules are a lot different. And I'm sure eventually you guys will get me to do a more of a short-term thing on one of these live streams. That'd be cool. All right. That's the content. So that is the content for today. But let's get back to the chat. Let's get caught up here. Jordan says Chapter 11 allows a company to stay in business and operate as usual as the company gets restructured and the finance balance. It stops all creditor interest and allows for easy repayment. Okay, so there's still hope. There's still hope for Tupperware. I like that. They do make some good stuff, but I just never buy it. But they do make some good stuff. JJ says, I finalized my Q trade and kind transfer to Wealth Simple. Nice, nice. Coffee at almost 8 p.m. I hope it's decaf. I won't be able to sleep if I drank coffee at this hour. I'm sticking to tea. This is not decaf. I'm actually fine. What it does mean, though, is that I'll probably have to pee in the middle of the night. That's fine. That's fine. Let's see. By the way, I really enjoyed the QQQY deep dive you uploaded this morning, and let's say a chef's kiss. Nice, nice. Now, those of you who didn't hear the one before the QQQY, I accidentally uploaded the raw video. That was actually funny. So that was the REIT one. I accidentally, for whatever reason, normally when I go to upload it, it automatically defaults to the right folder where I keep it, the edited version, but it didn't. It actually went into my download folder where I downloaded it. And so, yeah, it was like, you got to see everything. And you see me say the same line over and over again until I got it right. I was like, okay, there we go. So those of you who did get to see that, you get to see it behind the scenes, and you kind of get an idea of the amount of work that goes into get everything shimmered down to that thing. JJ says, by the way, I really enjoyed. Oh, yeah, we already did that. And see, I believe Ian mentioned the tax loss. Yeah, I thought it was Ian, actually. I did think it was Ian. JJ says, I never pay for an AUM percentage-based advisor. They're always sellers. Yeah. I would love advisors that would come along and they don't get paid unless they make you money. That to me, and I know nobody's going to probably work that way, but it just seems to me that if you're losing money, why should they be making money? Because their job is to make you money. But anyway, let's see. If you have to pay for an expert, always go flat fee or hourly rate based. Yeah, good point. Good point. All right. Yes, the kitty. And winter has come. You wouldn't know that here today. I mean, it was once again another warm day. I think as far as the forecast goes, I think it's supposed to be warm like into next week. So who knows? Who knows? VLG says she's adorable. How many kitties do you have right now? We just adopted 3. We have 3 cats. So we have there's a black cat named Riley, and then you guys just met Winter. Then there's sort of a ginger tabby like cat. She's not really ginger, but she has some ginger in her. Her name is Autumn. So, because she has like those colors that sort of fit with Autumn, and Winter looks like she could disappear in a snowbank. So, yeah, that's the way we handle it. I want to name the next cat Spring, but I don't think Jill will go for it. But that's what I want to do. That's what I want. Jonathan says, when investing in an unregistered account, would it be a good idea to DCA into a Canadian dividend ETF all the way into retirement? No rebalancing, no thinking, build up an income. Yeah, if you're in a non-registered account, absolutely, that is one option that you could do. So DCA, I think, is the best way to go with anything, especially long-term. Just get a schedule going and invest in it. One thing I would say, depending on how far away that retirement is I would almost look at something that's more of a total return opposed to a straight income. Because if you have room for your straight income, you want that in your TFSA. So something with a smaller dividend amount, but with a half decent growth over time, like VFV, for example. That wouldn't be a bad one. So just something to keep in mind in that portfolio. All right. Vineet says, best day to take profits. Best day ever, all-time high. So there we go. Yeah, now today, today was a good day. I kind of suspected we were going to get a good day today after yesterday. Because I kind of mentioned, like yesterday on the market close, I was mentioning that, tomorrow we should have calmer heads prevailing because people will stop overthinking the rate cut. And that's good. So I think tomorrow will also be a half decent day as well. Now I am on the air tomorrow for the market close. So definitely show up for that. It's going to be, it's going to be fun. I think it'll be fun. And I think it's going to be green as well. Let's see. I tried to sell all of my RS, stuck with low liquidity, so only 1/5 of all my shares got sold. That's one of those things is that when you do invest in some of these lower liquidity stocks, sometimes it can be hard to get rid of them. You just because you need a buyer on the other. Every transaction has a buyer and a seller. So sometimes that will happen. Now with higher volume stocks, companies like, for example, Wealthsimple will they will be able to they usually will buy like a whole bunch of it and they'll already have it in stock. So a lot of times, you can move things super, super fast that way. But something like RS, you kind of have to, it's a liquidity. It's one of these things, and I've been there before. So definitely, let's see. I'll hop on as a guest tomorrow, maybe. It's a possibility. After, it would have to be after the bell, of course. But if you want to drop on, if you want to jump on later, that would be absolutely fine with me. Absolutely. All right, everybody. I think we've come to the end. Once again, another fantastic channel member live stream. Be sure to get your ideas over on that community tab for the members choice video, because I'd love to get that vote out as soon as possible to give you guys time to vote. And then I will be back here again tomorrow for the market close. I will see you guys then. I think it'll be fantastic. Until then, everybody, thank you once again for being channel members and have yourself a fantastic evening. Bye, everybody.